On Friday, January 30, 2026, the silver market didn't crash. It was executed. 37% of its value was erased in 6 hours with zero headlines. Most people believe markets move on supply and demand. The data shows something different. Price is a managed narrative controlled by the CME Group, and when silver hit $121 per ounce on January 28, the system didn't celebrate the breakout. It deployed the kill switch. You see, silver isn't just a commodity, it's a threat. When it surges, it exposes the mathematical collapse of fiat currency, which means the system has one job: suppress the signal before the public notices the fire. The mechanism is already in motion. 4 margin hikes in 6 weeks. A coordinated execution disguised as risk management. And if you're holding paper silver right now, you're not holding an asset, you're holding a claim that can be deleted. Today, I'm breaking down the 3-stage execution protocol: the margin weapon, the legal trap hidden in UCC Article 8, and the physical decoupling that's already begun. We just entered the endgame. A mandatory protocol before we open the file. This is not financial advice. I'm not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The execution didn't start on January 30. It started on December 12, 2025. That's when the CME Group raised margin requirements by 10%. No explanation, no press release. Just a quiet adjustment buried in a PDF sent to brokers at 4 p.m. Eastern. Most traders ignored it. Margin hikes happen. It's part of the game. But 17 days later, on December 29, the CME struck again. This time, they raised margins by 25% overnight. Not over weeks, not with a grace period, overnight. You see, margin is the collateral you're required to post to hold a futures contract. When the CME raises that requirement, you either deposit more cash immediately or your broker liquidates your position. No warning, no appeals, just forced selling. Which means a 25% hike doesn't just affect new traders entering the market, it triggers a wave of automatic liquidations across every leveraged position already open. Plus, the CME didn't stop there. 24 hours later, on December 30, they raised margins again. The third hike in 48 hours. At this point, the total increase from December 12 to December 30 was over 40%. Think about what that does to your account. If you were trading silver futures with $50,000 in margin, you now needed $70,000 immediately. Or your position gets closed. The system calls this risk management. The math calls it a forced liquidation event. But the kill shot came on January 28, 2026. Silver had just hit $121. The largest single-day surge in modern history. Retail traders were euphoric. The squeeze was working. Victory was close. And that's when the CME deployed the final strike. They didn't just raise margins again. They restructured the entire system. Instead of fixed dollar requirements, they shifted to percentage-based margins tied to account risk profiles. For accounts classified as speculative or high risk, the new margin requirement was 12.1% of the contract's notional value. You see, this wasn't about protecting the market. It was about weaponizing volatility. The higher silver went, the more margin you needed, which means the rally itself became the mechanism of its own destruction. Let's do the math. A single silver futures contract controls 5,000 ounces. At $121 per ounce, that's $605,000 in notional value. Under the new percentage-based system, you'd need $73,205 in margin just to hold one contract. Before December 12, that same contract required $42,000. That's an 80% increase in 6 weeks. Which means if you didn't have an extra $31,000 sitting in cash, your broker sold your position. Not because silver was weak, not because you were wrong, but because the exchange changed the rules in the middle of the trade. The result was predictable. A tsunami of forced sell orders hit the market within hours. Silver dropped from $121 to $76 in a single session. 37% gone. Your screen showed a crash. The data shows an execution. If the math behind this margin protocol just clicked for you, or you want to track these systemic shifts as they happen in real time, join the Forensic Circle by hitting subscribe. The next phase is already in motion. Let's move to the deep dive. But even this 80% margin hike is a distraction from the real trap. You see, the CME can liquidate your futures position, but what about the investors holding physical silver certificates and ETFs? They think they're safe. They think they own metal. The law says otherwise. And the fingerprints are buried in a legal code most people have never heard of, UCC Article 8, which means your silver might not be yours at all. Here's the smoking gun most investors will never see until it's too late. When you buy silver through a brokerage account, an ETF, or a digital certificate, you don't own silver. You own a security entitlement. That's not my opinion. That's the legal definition under the Uniform Commercial Code, Article 8. You see, UCC Article 8 was designed to streamline the digital trading system. It allows brokers and custodians to hold your assets in a pooled account rather than segregating them individually. The system calls this efficiency. The fine print calls it something else. Your silver is now their collateral, which means if your broker or custodian has a short position that's bleeding, they can legally pledge your holdings as collateral to cover their own margin calls. You won't get a phone call. You won't get a vote. The law already gave them permission when you clicked agree on the account terms you didn't read. Let me show you the exact language. UCC Article 8, Section 503, subsection B, states that a securities intermediary, that's your broker, may use a financial asset held for the account of an entitlement holder as collateral for its own obligations. Read that again. Your broker can use your silver to cover their debts. Plus, if the broker fails, you're not a secured creditor. You're an unsecured creditor, which means you get in line behind the banks, the bondholders, and the derivative counterparties. By the time your claim is processed, the vault is empty. The system designed this on purpose. Paper silver was never meant to be redeemed. It was meant to be a tracking number in a database that could be erased when the music stopped. But let's assume you're smarter than that. Let's assume you avoided the ETFs and the futures and the digital certificates. You went straight to the source. You tried to buy physical metal. That's when you discover the second layer of the trap. The physical decoupling. When paper says 75, but reality says 120. The spot price of silver, the number you see on every financial website, closed at $76 on January 30, 2026. That's the official story. That's what the CME futures market says silver is worth. But if you try to buy an actual ounce of physical silver right now, you're not paying $76, you're paying $106. That's a 40% premium over spot. You see, the premium is the market's way of telling you that paper and metal are no longer the same asset. Paper is a claim, metal is reality, and reality is in short supply. Let's start with the mints. On January 27, 2026, the United States Mint announced that American Silver Eagle sales were temporarily halted due to inventory exhaustion. Not low inventory, exhaustion. Which means the U.S. government, the entity that's supposed to have unlimited access to domestic silver production, ran out of coins to sell to the public. Plus, this wasn't an isolated event. The Perth Mint in Australia suspended wholesale silver orders on January 23. The Royal Canadian Mint is operating on a 6-week backlog. The Austrian Mint stopped taking new orders entirely. These are the largest sovereign mints in the world. And they're all saying the same thing. We don't have the metal. But the paper market says there's plenty of silver. The COMEX warehouse inventory shows 263 million ounces registered and available for delivery. That should be enough to meet demand, right? Wrong. You see, registered silver is metal that's been approved for delivery against a futures contract. But approved doesn't mean available. Most of that metal is already spoken for. It's allocated to industrial users, long-term lease agreements, or institutional accounts that have legal claims on specific bars. Which means when a retail trader tries to stand for delivery demanding physical metal instead of rolling their contract, the COMEX has two options. Find unallocated silver somewhere else, or pay a cash settlement and close the contract without delivering anything. The data shows they're choosing option 2 more often than ever. In December 2025 alone, the COMEX settled over 18,000 contracts in cash instead of metal. That's 90 million ounces of demand that was not met with supply. The system calls this flexibility. The math calls it a fractional reserve bullion market. You're trading claims on metal that doesn't exist in the quantities the paper market suggests. And while the West is playing games with digital claims and cash settlements, the East is taking delivery of the actual metal. The Shanghai Exodus, 27 tons in one day. On January 29, 2026, the Shanghai Gold Exchange reported a single-day withdrawal of 27 metric tons of silver from its registered vaults. That's 867,000 ounces gone, delivered to private accounts and removed from the trading system entirely. You see, the Shanghai Exchange operates differently than the COMEX. In Shanghai, if you buy a contract, you take delivery. There's no rolling, no cash settlement. You either accept the metal or you don't trade, which means when Chinese buyers bid up the price, they're not speculating. They're extracting. And the vaults are being drained faster than the West can replenish them. Plus, this isn't just about silver, it's about the entire commodity collateral base that backs the global financial system. For the first time in modern history, central banks now hold more gold than U.S. Treasury bonds. Let that sink in. The world's reserve managers, the entities that are supposed to trust the dollar above all else, are dumping the IOU and buying the collateral. You see, a Treasury bond is a promise. It's a legal claim on future tax revenue that may or may not exist, depending on whether the United States can continue rolling over $36 trillion in debt without triggering a currency crisis. Gold is not a promise. Silver is not a promise. Metal is a mathematical constant. It can't be printed. It can't be debased. And it can't be deleted by a central bank policy meeting. Which means when you see central banks shift from bonds to bullion, you're not watching a diversification strategy. You're watching a vote of no confidence in the system itself. Let's connect the dots. The CME raised margins 80% to force liquidations. UCC Article 8 allows brokers to pledge your paper silver as collateral for their own debts. The sovereign mints are running out of physical inventory. The COMEX is settling contracts in cash instead of metal, and the Shanghai vaults are being drained by buyers who understand that possession is the only position that matters. This is not a market correction. This is a controlled decoupling. Paper silver is being sacrificed to protect the dollar. Physical silver is being hoarded by those who know the script. The paper price says $76. But paper is a tracking number in a database. Metal is reality, and reality is trading at a 40% premium because the people who control the metal understand what's coming next. You see, the system didn't crash silver to $76 because it's worth $76. They crashed it because if silver had stayed at $121 for even one more week, the public would have started asking the one question the system can't afford to answer. If silver is surging, what does that say about the dollar? Which means the violence of the attack tells you the value of the target. But this 37% execution isn't new. It's not even original. You see, the CME has run this exact playbook twice before. 1980, 2011, and now 2026. The dates change, the margin hikes change, but the script is identical, and the third act is always the same. Total system failure. The playbook, 1980, 2011, 2026. This isn't the first time the system has executed silver at the peak. It's the third. And the script is identical every time. 1980, silver hit $50 per ounce on January 21. The Hunt brothers, two Texas oil billionaires, had been accumulating physical silver for years. They understood the same thing you're learning right now. Silver exposes the fraud of fiat currency. The more silver surged, the more it revealed that the dollar's purchasing power was collapsing, which means the Federal Reserve and the COMEX had one job: kill the rally before the public noticed. On January 21st, 1980, the COMEX introduced Rule 7. It was called Silver Rule 7, and it banned all new long positions in silver futures. You could only sell, you could not buy. You see, this wasn't a market mechanism. It was a legal execution. The moment the rule was announced, silver had no bid. No buyers were allowed. Only sellers remained. Silver crashed from $50 to $10 in less than 3 months, an 80% collapse. Not because demand disappeared, but because the exchange deleted the ability to express demand through the futures market. The Hunt brothers were liquidated. Their empire was dismantled. And the message was sent: if you challenge the dollar with silver, the system will change the rules mid-game and erase you. But the cycle doesn't end. It repeats. Fast forward to 2011, silver hit $49.80 on April 25th. This time, it wasn't the Hunt brothers. It was a global wave of retail investors who had watched the 2008 financial crisis and lost faith in the banking system. They bought physical silver. They bought ETFs. They bought futures contracts. And once again, silver became a referendum on the dollar's legitimacy. You see, when silver surges, it's not just a commodity play. It's a vote of no confidence. And the Federal Reserve cannot allow that vote to reach critical mass. So the CME deployed the same playbook with a modern twist. Instead of banning buyers outright, they raised margin requirements 5 times in 9 days. May 2nd, May 9th, May 16th, and twice more before the month ended. Each hike forced another wave of liquidations. Traders who were winning were suddenly forced to deposit more cash or watch their positions get closed automatically. The selling pressure wasn't organic, it was engineered. Silver crashed from $49 to $26 in 6 weeks, a 50% collapse. Same script, different year. And now, 2026, the largest silver surge in history, $121 per ounce. The biggest single-day rally ever recorded. And the CME responded with the fastest execution protocol in the playbook's history: 4 margin hikes in 6 weeks. The final shift to percentage-based margins that made volatility itself the weapon. 37% erased in 6 hours. You see, the math doesn't care about exceptionalism. The script repeats because the system has no other option. When silver exposes the dollar's debasement, the exchange must intervene. The only variable is the speed of the execution. 1980 took 3 months. 2011 took 6 weeks. 2026 took 6 hours. The script is accelerating. The $300 trillion wall. Why silver cannot be allowed to win? Let's zoom out and connect this execution to the bigger cycle. Silver didn't surge in a vacuum. It surged because the global debt system is approaching mathematical collapse. As of January 2026, total global debt stands at $315 trillion. That's not a political talking point. That's the Bank for International Settlements' official tally. Sovereign debt, corporate debt, household debt, all of it. You see, debt is only sustainable if the entity that owes the money can either grow fast enough to service the interest or debase the currency fast enough to make the nominal debt shrink in real terms. But we've reached the end game. Growth is stalling, productivity is flat, and the only tool left is debasement. Print more currency, expand the money supply, inflate away the debt. Which means every dollar, euro, yen, and yuan is being systematically destroyed to keep the debt machine running. And that's where silver becomes a problem. You see, silver is the mirror. When the dollar debases, silver's purchasing power rises. 1 ounce of silver bought roughly the same amount of bread in ancient Rome as it does today. The metal doesn't change. The currency does. Which means if silver had stayed at $121, the public would have started doing the math. If silver is up 300% in 2 years, what does that say about the value of the dollar? If central banks are hoarding gold and draining treasury bonds, what does that say about confidence in U.S. debt? The system cannot allow those questions to reach mainstream consciousness, not when $315 trillion in debt is sitting on a foundation of pure trust in fiat currency. Plus, the 2026 maturity wall makes this even more urgent. Over $8 trillion in corporate and sovereign bonds are set to mature in 2026 alone. That debt has to be refinanced, rolled over into new bonds at higher interest rates. If confidence in the dollar cracks, if silver hits $500 and gold hits $5,000, the cost of refinancing that debt explodes. Yields spike, defaults cascade, and the entire debt pyramid collapses. Which means the CME's margin execution wasn't just about protecting traders from volatility, it was about protecting the dollar from exposure. China's checkmate, the January 1st reclassification. And while the West is suppressing silver's price, the East is treating it like a weapon. On January 1st, 2026, the Chinese government officially reclassified silver as a strategic national security resource, not a commodity, not an industrial input, a national security asset. You see, this classification puts silver in the same category as rare earth elements, uranium, and semiconductor-grade silicon, materials that cannot be exported without state approval, materials that are stockpiled for geopolitical leverage, which means China is no longer trading silver on the open market. They're accumulating it, hoarding it, and preparing to use it as a bargaining chip when the dollar's reserve status finally breaks. Plus, the timing is not a coincidence. January 1st, 2026 is the same day the expanded BRICS coalition launched its commodity-backed trade settlement system. 9 countries, 45% of global GDP, and all of them are moving away from dollar-denominated transactions. You see, the petrodollar system that gave the United States a 50-year free lunch is ending. Saudi Arabia is now accepting yuan for oil, Russia is settling trade in rubles and gold, and China is stockpiling silver while the West sells paper claims. This is not a market. This is a controlled demolition of the old monetary order, and the entities that understand the script are taking delivery of hard assets while the price is still suppressed. The cycle is clear. 1980, 2011, 2026. Every time silver threatens to expose the dollar's debasement, the system deploys the same execution protocol. Margin hikes, forced liquidations, crash the price. But this time, the script is different in one critical way. The debt wall is $315 trillion. The maturity crisis is here. And the East is no longer playing by Western rules, which means the 37% crash you just witnessed wasn't the end of the silver story. It was the beginning of the endgame. You see, the system didn't kill silver because it's worthless. They killed it because it's the one asset that tells the truth about what's coming next. And the intensity of the attack is proportional to the value of the target. Most people will watch this data, nod along, and then go back to trusting the system that just executed 37% of silver's value in 6 hours. They'll believe the headlines, they'll trust the spot price, and they'll learn the hard way that paper claims and physical reality are no longer the same thing. But if you're the type of person who refuses to be a victim of the script, if you understand that the 2026 maturity wall is not a theory but a mathematical deadline, then you need to track these shifts as they happen. Subscribe now. This forensic circle operates at a different standard. We don't wait for the headlines, we read the fine print before the execution begins. The next phase is already in motion. Here's what you need to remember. Paper says silver is $76, but paper is a claim that can be deleted. Metal is reality. The CME raised margins 80% in 6 weeks. UCC Article 8 allows your broker to pledge your holdings as collateral for their debts. The mints are out of inventory. The COMEX is settling in cash instead of metal. And Shanghai is draining 27 tons in a single day while the West sells claims on metal that doesn't exist. This wasn't a crash. It was a controlled execution. And the system didn't do it to protect you. They crashed the price to protect the dollar. Because if silver had stayed at $121 for one more week, the public would have started asking the one question the $315 trillion debt machine cannot afford to answer. What does this say about the currency? The intensity of the attack tells you the value of the target. The script is accelerating. The vault is draining. And the 2026 deadline is no longer theoretical. Paper or metal. The choice has already been made for most people. Make sure it's not made for you.